Welcome to this week's Mortgage Market at a Glance for the week of May 27, 2024. So, this past week was pretty uneventful in the financial markets. Nothing too wild in the terms of data or volatility. But we did hear a lot from the Fed, which helped confirm what most of us already knew. Initially, people were expecting many rate cuts in 2024, but now it looks like we might only get one, maybe two, depending on what the jobs report reflects in the coming months. Now, looking ahead, a rate cut at the July Fed meeting might seem nearly impossible, even though it seemed likely back in early April after the CPI report. And again, this will depend on the jobs report to be released on June 7th and July 5th. If those reports push the unemployment rate to 4% or above, then I'm expecting a rate cut. Last week's data didn't really change the negative sentiment about rate cuts. Several Fed officials gave speeches emphasizing their cautious stance due to the first quarter's hot inflation data. My key takeaway from their comments: they all talked about inflation and the need for them to see more data or more time for tightening to work. When I look back, the Fed began raising rates in March of 2022. It's now been over 2 years for the tightening policy to work. Granted, it does take time for these sort of things to work their way through the system, but the Fed did raise rates at the fastest pace in U.S. history and by the most amount in that period of time. Yet inflation is still well above 2%, the 2% benchmark. What that has done is put more pressure on employers who must service their debt or refinance the debt at now a higher rate. That is beginning to put pressure on the carrying cost of a business. And the biggest carrying cost of a business is, well, the employee in many cases. So many employers are faced with laying off employees to stay in business. This is why I'm closely monitoring the employment situation over inflation currently. The Fed's motto remains the same: data dependent. It's just which data they are dependent on has everyone guessing. Another notable report was the inflation expectation component of the Consumer Sentiment Survey, which saw unusual movement in the opposite direction from its initial reading. Now, despite holding ground, the move toward the rate range ceiling meant mortgage rates were higher last week. This contrasts with Freddie Mac's weekly mortgage rate survey, which averages rates from Thursday through Wednesday and reports the next day. This can cause discrepancies, especially with big rate drops or jumps midweek. Freddie's survey doesn't include discount points, which are now more common than before, which explains some differences. But the key takeaway is the rate movement over time, not the specific rate. Now, looking ahead, this week has more scheduled events that could impact the bond market, with Friday's PCE price index being the most important, which is comparable to the CPI report. So stay tuned for that. If you'd like to know more, reach out to me. I'd like to meet you. If you're looking to purchase or refinance a home in Arizona or Texas, I'd like to be your broker of choice. Until next time, take care and stay safe.